even if it's not 100% the right thing to do, or if it's not the best thing to do, I've seen more people make mistakes by not taking action than people that have tried to take action and it's just been a bad investment decision.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, I'm excited about this one. I like this episode. We put it together and you know that you've got a good one when you're looking forward to the episode more than most. We're always looking forward to the episodes.
This is great actually. And you know, we were going back through the catalogue and in our 174th episode, we haven't done this before.
Yeah, I don't think we have.
This is something new.
I mean, I'd be happy to be called out in case we have, because I tend to forget some of the earlier episodes that we did do, but I don't think we have.
And this one, just when you came up with it, so you need to take the kudos with it, but when you came up with it, I'm like, why haven't we haven't done this before, and why haven't we done it before?
Yeah.
Anyway, look, enough of a teaser. What are we talking to everybody about today?
So today we're talking about some of the common financial mistakes that even smart people make. I mean,
which is basically all of our listeners and our viewers, right?
Exactly right.
The smartest ones listen to the 360 Money Matters podcast.
Exactly. So what are the common mistakes that viewers of the 360 Money Matters podcast might make with their finances?
That's it. Well, the first one is not being a client of 360 Financial, right? That's the first thing.
That's mistake number one.
Actually, that's it. That's the end of the podcast. Thank you, everybody. We'll catch you later. Now, on a serious note, look, there's some really good ones in the list, and seeing them written down on, I was going to say on paper, on the screen, is
kind of jogs back your memory sometimes with like meetings and clients.
Okay, I've seen that. And we talk about this all the time, but putting them down into a list, I think is going to provide a whole heap of value to everybody. Andrew, let's kick it off. What's the first one that we tend to think about? What are the most common mistakes that even the smartest people make with their finances?
I think that this is the biggest, if not at least top 2 or 3 mistakes that I see people make.
Called it.
Is lifestyle creep.
Yep.
I mean, it's so common that you see someone who, you know, they maybe started as a client and initially, you know, you're talking about cash flow management, you're talking about budgeting, you're keeping a really tight budget, and then income increases, and all of a sudden, you know, as do expenses, and, you know, so on and so forth. And before you know it, it's like you sit back and you take stock and you're like, hold on, your income is 3x what it was when we were initially talking, and you still have the exact same problems with money. That is a perfect symptom of lifestyle creep. And sometimes it's not just dumb crap, right? So I'm going to put it out there and say, I encompass in lifestyle creep, not just, all right, you know, I used to buy and I'm just looking at pens here, but I used to buy a pen from, you know, Target, and it cost me basically nothing. And, you know, now I buy Mont Blanc pens because, you know, I want to look fancy. It's not, that's your typical lifestyle creep. But another lifestyle creep, which is just all too common, is, okay, you know, I used to be able to afford a house that's, you know, $1 million, and now I'm buying a $3 million property. And it's like, well, you know, do you actually need to, is that fulfilling anything in your life? Is that really important? And it is an asset, so it can be a lot harder to distinguish. But lifestyle creep is one of the major things that set people back from not being able to achieve their financial goals.
Yeah, and look, whether we like it or not, in economic speak, or when you look at the data, this is actually a phenomenon that happens as people's incomes increase. Yeah. It's just a naturally occurring thing because, you know, as we progress and as we start to earn more money, we tend to want more and more, not necessarily just things, but better and better experiences, better and better things. So there's this constant pressure, I feel, just, you know, that is inbuilt in us as humans. Maybe it's a survival mechanism that you want to just do more, and stuff costs more, right? So I think you've hit the nail on the head. Lifestyle creep, if you can almost somehow have the discipline to put that aside, and it's difficult to do, and try and silo it out and say, okay, I've gone and earned more money because I've got a promotion or, you know, pay increase or what have you. if you can put that aside and do something with it, obviously it's going to make such a substantial difference. So I think you're right. Lifestyle creep is definitely up there. I think what goes with lifestyle creep as well too, the thing to try and help offset that, rather than relying on motivation and discipline, is, and one of the other big mistakes that we have is not necessarily not having a budget, but not having a banking strategy.
Yep.
So the way that we tend to talk to people about this and how we educate people through this process is we build a banking strategy off the back of a budget that somebody completes. So the budget per se is irrelevant to a certain extent after it's used and the banking strategy is deployed. So if you don't have a banking strategy, you don't have the physical mechanisms in place to stop the overspending or the lifestyle creep. It's too easy to put stuff on credit, and before you know it, you're spending more than you earn. So I think the second one for me, which is definitely up there with your one, Andrew, I think, is not having a banking strategy in place. That's a huge one.
Yeah. I mean, a budget is just a picture if you don't have a banking strategy.
Yep.
All it is just a picture of where you spend your money, but it doesn't actually give or do anything if you don't have the banking strategy to support it. Look, I think another one which is really common is just putting all your eggs in one basket. Now, what that basket is can change for a number of people. You think about self-employed people or someone who's self-employed. You don't pay super, you don't draw money out of the business because you want to try and keep it all within the business because you can control and generate a greater rate of return. Or someone who has had some success in real estate, and so all you do is just constantly acquire real estate or shares or whatever it is. But putting everything in one bucket is another mistake that we've seen people make, in that, if that asset class or if that asset that you're putting everything into doesn't perform as well as what you expected to, or has a dip or has a fall, it can leave you very, very, very exposed.
Yeah. Yep, absolutely. One of the ones for me, emergency fund, either not being adequately funded or not being present at all. Yeah. So, obviously we're big advocates of making sure that you've got some sort of pool of money that you can draw on in an emergency. Where that money's stored, it doesn't really make too much of a difference as long as you can get access to it quickly. But whether it's too shallow, so the amount of money that you've got set aside is not big enough to cover off on those things, or just not having it all. Yeah. Having it at all. And that's obviously just a circumstance that somebody finds themselves in. But once again, that's kind of one of the foundational building blocks that when we're putting a financial plan together is making sure that that's in the right place. But that's definitely one from my perspective, not having an emergency fund or not having it adequately to the size that it needs to be.
Yeah. And sometimes people can forget that as your expenses, as the complexity of your life with kids and all of that stuff comes into the mix, so should the goal around your emergency fund. I mean, someone who's, single, living at home and saving up for their first home deposit doesn't have many expenses, like their emergency fund or their requirement around their emergency fund is going to be very different to, someone who their income is higher, they've got a mortgage, they've got kids, they've got other expenses and obligations that they need to have. And so you need to, consider what your emergency fund looks like as your circumstances and life circumstance changes as well.
Yeah. Andrew, no clear investment strategy, or just going through the motions and just trying to acquire assets.
Yeah.
Very easy to do, to the extent where life is just so busy doing it, you're doing its thing. You may not necessarily get the opportunity. And this is one of the benefits of going through the advice process, is sitting down with somebody and mapping that out and saying, okay, what's the strategy that sits behind it? Or, I think I should buy this, or, this asset I heard on TV is going to be the next thing. So I'll go and do that. And then the next minute I'll jump over here, and so on and so forth. That could be hugely detrimental. And once again, I don't want to necessarily say, there's a correlation between smarts and income here, but if you've got a decent sized income, then it's easy to cover that up because you've always got a solid amount of income to be able to kind of cover over those types of things.
Yeah.
So not having a clear investment strategy, and just being on that hamster wheel of acquiring assets is another one on my list.
Yeah. And it's a really easy one to fall into, and you're almost rewarded for making that mistake because you're acquiring assets. And so sometimes it's another example of it is if you don't have an actual strategy or you don't know what you're doing, you almost get that endorphin hit by acquiring an asset. So I've been in instances before where, you talk to someone and I have 7 properties and it's like, that's great, but what are you doing it for? Yeah. And what type of properties are there and what are you trying to achieve? Because, in this particular scenario, it was someone was chasing that endorphin hit of saying, I've got X amount of properties. So they're looking for the cheapest property that they could buy. And if you put that all together and you look at it and say, well, that's actually the equivalent of 1 or maybe 2 investment properties. You're not acquiring the best asset. All you're doing is just trying to acquire. And what that's leading to is just getting a number and being able to say that number.
They're all student accommodation.
Basically.
I've got 7 properties, all student accommodation. Nah.
It's basically not what good. It was.
Yeah, not good.
And look, another one which it's on either side of the equation, right? Neglecting tax planning. So yes. you're acquiring assets, which is, a good thing, but you're also paying a tax to the ATO as a result of it, or, which is also very common, focusing too much on tax minimization. Yeah. So there is a fine balance between, okay, I need to reduce and minimize my tax and make sure that the dollars that I'm getting in, I'm retaining and not paying that out. But then on the flip side of it, being so focused on tax minimization that you're not actually growing your wealth is also another common trap to fall into, because the fact of the matter is that if you're going to make money, you're going to pay tax. And so focusing too much on minimizing tax means that you're also minimizing your wealth creation as well.
Yeah. And look, we say it all the time to people and clients, and we say, look, paying tax is a good thing. And just that sentence alone, people think that we're crazy, but you're right. You get to a certain stage, you need to optimize your tax position and minimize your tax payable. But the focus should be on increasing income, because that's really the thing that's going to move the needle over time.
Yeah.
Right. So both go hand in hand, but you're absolutely right. One of the other ones for me, Andrew, is relying on one income stream. So, you hear it when you're reading different financial literature and different bits and pieces like that. But if people have got diversified income streams, we tend to call them passive income streams and stuff like that as well too. The more income streams a person can have, generally speaking, the better off they are going to be financially. Now, there's a bit of a trap with that. Maybe you're spreading yourself too thin and not really giving any one thing particular attention. But just sort of, if we exclude that one for the sake of the point that I'm trying to make, having one income stream is definitely, not the ideal position to be in the absence of a backup plan. So maybe we can elaborate on that a little bit more, Andrew.
Yeah, I mean, look, relying on one income stream can take a variety of forms, whether that's all that you're relying on is putting money into a business and that business is delivering you some level of income, whether that's putting that into one particular asset class because you just feel comfortable and you know that asset class. I mean, having a backup strategy in place in the form of, whether that's an insurance policy, whether that's, making sure that you're slowly reducing how much you have in that asset and using that income to, create another income stream, whatever that looks like, having another strategy to sit outside of that and diversify the income that comes in is really important. And sometimes you even see it in, household scenario, and you look at, maybe there's only one person working, maybe there's a partner that's staying home to look after children, maybe there's a mortgage, maybe there's private school fees, maybe there's an investment strategy. And it's like you start to, until someone says it, and I think that once you say it, the penny tends to drop for most clients is, hey, look at all of this stuff here, in your mortgage, in your kid's education, in, just being able to put food on the table, in your wealth strategy, in your retirement planning, all of that is relying on one thing. And that's that this person continues working and continues being able to generate the income that they're receiving. And if they're sick and if they're injured or if they pass away or if anything happens, look at how many people are impacted by it and how much falls apart as a result of it. And then the conversation is, okay, well, how do we protect it? Look at life insurance policies, income protection, all of those things that you can put in place. But yeah, it's definitely a significant risk and can be a very common mistake.
Yeah. Short-term gains. So focusing on short-term gains rather than the longer-term strategy.
Yeah.
Because it's always easy enough to get distracted by the short-term gains, the shiny things, the lady in the red dress, thinking of the Matrix analogy.
Yep.
It's easy to get caught up in it.
Yeah, absolutely.
And not focus on longer term.
Yeah. Yeah. And I think that all ties into, having that goal, having that strategy and knowing what you're aiming for. But focusing on the short-term gains, you're looking at really one very small aspect of wealth creation. And yes, the next 6 months and the next 12 months or the next 1 month is important, but you need to look at the bigger picture. You need to look at the overall strategy.
Just thinking about Fleetwood Mac Andrew, about Don't Stop Thinking About Tomorrow, the song in my head, and I'm playing it over and I can't even talk properly.
It's because the song's playing, that's why.
That's the thing, right? So yeah, keeping an eye on the longer term and not getting distracted by the shorter term stuff is probably where the thinking goes with that.
Opportunity cost of sitting on the sidelines. That's another one of my favorite.
Yep.
Sometimes, and we're talking here to, mistakes that really smart people make, which is, intelligent people will analyze something.
Yeah.
They'll look at, hey, what's the best way that I can maximize it? Is this the right thing to do? Are there any other options? Your serial overthinkers is what we're talking about here. And you've just sat on the sidelines because inaction doesn't feel like you're taking, a course of action. And so as a result, you're just analyzing and over-analyzing everything and not making any decisions, which means that you're missing out of all of that growth along the way. Imperfect action is better than inaction. So a lot of the times just being there, even if it's not 100% the right thing to do, or if it's not the best thing to do. I've seen more people make mistakes by not taking action than people that have tried to take action and it's just been a bad investment decision. So making sure that, yes, analyze things. Yes, make sure that what you're doing is the right thing, but not overthinking it is an important element to it as well.
Yep. I reckon this one should have been at the top of the list, Andrew.
Yeah.
This should have been at the top of the list, but we're saving one of the best for last. There's a few more to go after this, but trying to time the market. It's a useless exercise and it takes a lot of energy out of it, and there's ways to be able to offset that. Look, there's some instances where there's an opportunity that gets presented when markets do correct. There's a very short window that you could tip in a large amount of money and try and get in from that perspective. But in our experience, seeing people trying to time the market, which then results in and leads to, similar to what you were talking about before, about not spending enough time in the market, absolutely the wrong thing to do. And it's not a fruitful exercise to go through. It's just a waste of time, effort, energy for the vast majority of people. And it's a really easy mistake to be made. And we see it all the time.
Yeah. Absolutely. You're better off just, when your circumstances permit, when your, cash flow permits, when things are right in, all of the strategy outcomes and all of that stuff that you're trying to deploy, you're better off being in the market, invest on a regular basis, make sure that you're doing it without necessarily too much think work, because you try and time the market, and I haven't seen anyone successfully do it, bar maybe a few people in the your Warren Buffetts of the world. Billy's best mate. Maybe he's one of the only examples of that's been able to do it with some sort of, and even that's imperfect. But yeah, completely agree with that one. Ignoring super is the last one that I'm going to talk about, just because we see it fairly often in that superannuation just seems so far down the track. It just seems so inaccessible that we see a lot of people that in their earlier years just ignore this massive opportunity. Yeah. And it's not about let's dump large amounts of money into it. It's about let's, build a long-term sustainable strategy that you're not overstep, or that you're not, putting too much in because you don't have the ability to draw it out, but neglecting some of the tax benefits that are associated with utilizing superannuation for wealth creation is a really, really big one that we see,
100%.
particularly with self-employed clients.
Yep. I mean, look, on that note, the reasoning that I tend to see, one, from a self-employed perspective, you see a lot of people that have the opinion that says, I could use that money better off today in my own business or doing something else with it, get a greater rate of return. It's available, so it's not preserved like it is in the superannuation system. That's probably the first one. The second one that I'm starting to see a little bit more of, which I kind of understand because of the political environment that we're in, is that there's a bit of a distrust here with the government, and the government are going to move the goalposts when it comes to superannuation. Now, yes, given valid point to take into consideration, at some point in time, everything changes, so it's inevitable that things do change. But if the government do make changes to superannuation, I still believe that it's going to be the most tax effective investment vehicle that we've got in Australia. Yeah. So even if they do tweak it around the edges, which they will no doubt do, to make the system more equitable and more efficient, or that's what they'll call it. I actually think that
I thought I was going to say to get more money in their pocket, but that's
100%, right? But I still think ignoring superannuation is a really common mistake that we're seeing that some really smart people are making.
Yeah, Bills, I think that that covers it really nicely.
Hope so. To our listeners and our viewers, I hope you got a whole heap of value out of that episode. If you want any further information, or if you've got some more to add to the list, feel free to reach out to Andrew and myself. Feel free to like, subscribe, and please share with family and friends if you've got some value out of this, so we can continue to grow it and bring more information and hopefully some entertainment to our listeners and our viewers. And on that note, thanks, Andrew.
Thanks, Bills. Look forward to catching everyone on the next one.
Thanks for listening today. If you have any questions on what we've talked about, or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature, and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of AMP Financial Planning.